Hello, clients, friends, and colleagues. This is Rich Siegel with ARQ Wealth Advisors. Today is Saturday, June 6th, and we wanted to put together another video for you. It's been a very wild ride in the economy and the markets over the last few weeks. So we thought this would be an opportune time to go over some of the numbers. Let's do that. Okay, great. So this is the first chart here is from CNBC. I've seen similar figures from the CBO, that's the Congressional Budget Office. And essentially what it's showing here is that we are in a recession. The first quarter of the year was down 4.8%. Actually, they just revised it down 5% for the first quarter. The estimate for Q2 on an annualized basis is minus 34%. So this should come as no surprise. The government shut down the economy. This number here is kind of on par with the Great Depression. However, this is not a depression-style contraction. Interestingly, estimates for Q3 are up 13.5% as the economy opens around the country, and then also in Q4 expansion. So by all estimates, I'm hearing an annual rate for 2020 of somewhere in the -5% to -7% for the year. If this indeed is anywhere near correct, this will be one of the shortest and deepest recessions of all time. This is a chart we built here with 5 different metrics. The first metric, again, is the GDP figure. For context, these are 5-year numbers, 5-year charts. So you can see GDP in the 2% range, 2.5%, 3%, and here, first quarter, down 5%. Inflation has fallen off a cliff, primarily because of energy. But as oil has rebounded, I think we'll see these numbers pop back up in pretty short order. Unemployment rate made a big splash yesterday in the news. The estimates were close to 20%. In actuality, jobs actually came back, and the unemployment rate actually shrunk from 14.4 to 13.3. That was a big surprise, and that's probably why the market had a great day yesterday. Consumer sentiment was close to all-time highs prior to the COVID-19 pandemic. Again, fell off a cliff here, and now we're kind of finding our footing here, okay? And finally, manufacturing has also come back a little bit here. Anything below 50 is a contraction in manufacturing, and you can see that there's been a little bit of expansion lately. So these are all good signs. The GDP number for Q2 will be quite ugly. The market already knows that. Everybody knows that. Unemployment to get back into single digits might take a couple of years. This is a very interesting chart here. This is the 10-year Treasury rate versus the 2-year Treasury rate. We've discussed this many times before. And as you can see back here last year in August, we had a inversion for like a day or so. And that basically typically foreshadows a recession. It was right this time, but this was not a structural recession. This was a recession based on a pandemic. However, what's interesting now is that you'll see this 10-2 spread is widening. That's a good sign. That basically means that longer-term Treasury yields are starting to widen out versus short-term Treasury yields. That's typically a good sign for the economy. All right, let's talk about some markets here. The first chart we'll talk about is bonds. And I built this chart based on the very bottom of the stock market collapse that was March 23rd. And leading up to that collapse, what you saw was Treasury bonds were the ultimate flight to safety. Treasury bonds did quite well while everything else collapsed. Now, it's important to note here that since March 23rd through yesterday, Treasury bonds, the green line here, fairly flat, small gain of about 0.75%. And then you'll notice here, there's 3 more indices. The first one I want to talk about is investment grade corporate debt. So this is high quality, or medium quality debt issued from U.S. corporations um, based on the Fed and the Treasury backstopping our credit system. Bonds have come roaring back. So the credit markets, corporate credit has grown quite a bit in the last 6 weeks, up almost 16%. The orange line is municipal bonds, up almost 9.5%. And then finally, our firm uses a sleeve of investments that we call non-traditional alternatives. They tend to have bond-like risk and volatility without the interest rate sensitivity. And again, this basket of non-traditional investments up 8.5%. So just the opposite has happened for the last month or two versus what happened in the stock market collapse. Okay, this is very interesting here. This is a chart just for last week for equities. You'll notice that healthcare stocks that were really holding up quite well while the market was collapsing, along with communication services and technology, we're kind of on the bottom of the return spectrum for last week. You'll notice that the more economically sensitive sectors, primarily energy and financials, industrials, materials, were up huge last week. And that's a really good sign. This is a sector rotation. We've expected this for quite a while. The Fab 5 stocks, the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, have really been lagging for the last couple of weeks. We'll talk about them in a few more moments. But basically, when the playbook for a recession is when you enter into a trough and then start moving into a new expansionary phase, the economically sensitive sectors tend to do the best and lead you out. And that's starting to happen now. So it's very interesting. To that point, here's a chart of, it's the last month. It's a 1 month chart. And what you'll notice here is over the last month, those FANG stocks were up 7%. Again, Facebook, Apple, Amazon, Netflix, Google. Okay. The S&P 500 in total, 500 stocks, up 11.6%. That's cap weighted. So what that means is that the stocks that have the largest capitalization have a very large impact on the performance of the sector. So if you looked at the constituents of the S&P 500, what you'll notice is the top 5 or 6 stocks make up over 20% of the index performance. Amazon, Apple, Facebook, etc. Okay. In the last month, the equal weight S&P, the green, meaning that all 500 stocks are equally weighted at 0.2% each, not cap weighted, up 18.5%. Additionally, the Russell 2000, which is small cap stocks, lots of energy and financial companies in that index, up also 18.5%. So the bottom line is, for the last few years, if you've been heavily weighted in those FANG stocks or the S&P 500, you've done quite well. But historically speaking, those parts of the market tend to lag a bit when you enter into a new economic expansion. So being diversified now is starting to work quite well. This is a chart here of the S&P 500. This is just for the last week. And the reason why it's a short term is because we're starting to see a new trend emerge. That's the weakening of the dollar versus other currencies. So the dollar has dropped 1.4% in the last week, which is a very large move, actually. And what you'll notice here is the S&P in the last week up almost 5%, but foreign markets, emerging markets, and developed markets, Europe, Australia, Japan, easily outperforming the U.S. market. And that is one of the results of a weakening dollar versus other currencies. Finally, just a few comments. Our clients have participated very nicely over the last couple of months with relatively moderate risk and volatility. That said, we feel that the markets have come a little bit too far, too fast. By any valuation metric, what we're seeing now is that stocks are probably ahead of themselves and need to grow into their earnings over the next year or so. So our plan here over the next few weeks is to take a little bit of risk off, kind of lock in some of these great gains that we've seen over the last month or two, We think we're probably due for some sort of correction at some point. The Fed has probably put a floor under the market, so we think those March lows are off the table, but we do think a 5 or 10% correction could happen at any moment. That's not a big drop in the market, but we do want to protect some of these assets, the growth of these assets. So again, our plan is to take some risk off of the equity markets on the margins. So with that, hope you enjoyed the video. Have a great day and enjoy your weekend.